Hello and welcome to another Private Markets Insider webinar. I'm Kevin McCaffrey with Private Markets Insider and Lacrosse Investments 37.4. I'm happy to be your host today, and I hope you had a happy Thanksgiving. Even if you're viewing from outside the US, I think we can all embrace Thanksgiving, right? It's so inclusive and simple. There are really only two features. First, connect with family and friends. Okay, that was tricky this year, more technology than travel for my tribe, but mission accomplished. And second, give thanks. That was somehow easier this year in the face of global strife and divisiveness. We were reminded how much is on the line, and it could be worse, folks. And we've started to see some silver linings. Vaccines coming to market, the Dow hit 30,000. Private deal markets are rebounding, but I myself, I was torn. I gave sincere and heartfelt thanks as I sat down to a turkey dinner. Meanwhile, I recognized that food pantries struggled to keep up with demand and the pandemic raged on. Now, as a whole, I'm an optimist. I believe society has made tremendous progress over time and we can thrive as humans. However, progress and proliferation breed more complexity, and our problems will require ingenuity, planning, cooperation, all prized capabilities of both the human race and our private markets industry. The private markets have historically done well. Bain says that over the past 30 years, US buyouts generated net returns of 13% compared with 8% for the S&P. And everyone wants to do good. Last year, I spoke with Larry Fink of BlackRock with over $7 trillion in AUM, and all he wanted to talk about was stakeholder capitalism. This year, his annual letter to CEOs placed long-term sustainability at the center of his investment approach. And Morningstar reported that in the US, assets and sustainable index funds have quadrupled in 3 years, now representing 20% of the total. And the US actually lags behind Europe ESG investing. So it's a positive story. And today we come together to talk about doing well and doing good. And if we combine the strength of the private markets with accelerating appetites for a better world, can the world do weller and gooder? Well, we'll see. But even if we can't be sure to do well, should we still do good? The disaster we call 2020 raises doubts. For many, it's tough to think long-term about altruistic efforts while the sky's falling. But let's remember, we've all questioned optimism in the past, and yet we just hit Dow 30,000. I mention that because I remember when I worked on the floor of the New York Stock Exchange in the trading pit. They passed out hats reading Dow 10,000. So exciting. But I was skeptical since it was 2004. It was already the second coming of Dow 10,000 following the internet bubble. I'd seen a couple major downturns and it seemed impossible we'd ever see 30,000. So what's next? Dow 90,000? Will we be doing well enough then to do some good? Is it too risky to act now, or is it too risky not to? Well, let's hear what some of our peers have to say, and like a private markets Thanksgiving, let's connect with our family of insiders and give thanks we can share in their insights. And let's get into it. First, a couple of program notes as we review the agenda here. I'll just share that on the screen. The following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, please use the Q&A feature you'll see there through Zoom, and we'll answer as many questions as we can during this webinar, and we'll follow up afterward to answer any remaining questions and to have conversations where appropriate. I'll take down the agenda here, but you can view these and more details on the speakers that are available on our website for Private Markets Insider. And now I'd like to introduce our first moderator for the first panel, Adam Smith. is a founder of several companies, including Circle Peak Capital, a merchant banking partnership, Big Sky Partners, a strategic and creative advisory shop, and Family Office Private Advisors, and investment banking and alternatives partnership. He's been an investor and advisor to tens of startup VC, PE-backed companies, and he's a Wall Street veteran with Salomon Brothers and JP Morgan, Lehman Brothers. He's also co-founder of Leukemia Fighters, an oncology philanthropy formed in collaboration with New York Presbyterian Hospital and Weill Cornell. And Adam will be our moderator today for the first panel on impact in the private markets. So with that, I'll remind our audience to write any questions in with the Q&A feature. And please, Adam, take it away.
Thank you, Kevin. It's great to be here and to speak at another panel and work with you and Jonathan. I've known Jonathan for many years and a good friend and a brilliant fundraiser. So it's great to be part of your organization. Thank you for inviting us today in this very important topic. I'm also very passionate about impact and the evolving ESG and CSR world, both for myself and my clients and my family. It's increasingly essential to be mindful of not only what we're investing in, but who we work with and how we're making a positive contribution to our world. In this case, through direct investing or private investing and liquid investing. So my colleagues here, I'll mention briefly, will go through their firms, their backgrounds, their activity and impact and ESG investing, areas that they're interested in and focused on and what they see going on in the marketplace. We have, as you can see, Rob Frankfurt, Marcia Nelson, and Jennifer Kenning. I've been friends with all of them for a bit of time or a long time in Rob's case, and it's great to have them as guests here with you. I'll introduce each of them briefly, and then we'll go back and forth and talk about the impact world. Rob, why don't we start with you? Tell us a bit about yourself and your firm and what's going on for Living Fund.
Yeah, thanks, Kevin, and thanks, Adam, for having me here today. My name is Rob Frankfurt, founder of the Living Fund. The mission of Living Fund is to invest in early stage businesses that fight chronic illness. So it's either a product or service that if you use that service or that product, will you be closer to health than towards chronic illness? That's my guiding light. I came to this world from the hedge fund world. I was an activist hedge fund manager, and it was in an investment in a women's plus size retailer, the parent company of Lane Bryant, that I learned about the obesity epidemic and then the related chronic illness epidemic. And when I started looking at where else I can use this knowledge in the public markets, I didn't feel a connection. It was more about maintenance of status quo than reversal or prevention. And in my own life, certain things, not really chronic illness, but injuries from sports led me to change how I live, how I eat, how I sleep. And that combination of work life brought me to starting to invest in early stage businesses. A few examples are Aura, which is a sleep and wellness tracker, and Parsley Health, to name a few.
That's great, thank you. Marcia, I've worked with in numerous occasions. She's in New York and building a new capital markets and also a women-oriented platform at ShareNett, which is a multifaceted capital markets business and family office club organization that I've known for a while. It's a very interesting growing company, and Marcia is just joined and building part of that business as a partner with her colleague. Tell us a bit about yourself, Marcia, and ShareNett, and what you guys are doing on the impact and ESG front.
Great, thanks, Adam. It's such a pleasure to be here today. I'm Marcia Nelson. I'm a managing director at ShareNett, which is a boutique investment bank that was founded by family offices and is for family offices in private investing. I personally care a lot about women and women entrepreneurs, female founders, and I'm leading ShareNet's new initiative called Change the Room, which is really to help build out awareness, support, and investment opportunities for women founders and women-led companies and fund managers. My personal passion in that space started when I worked in fashion publishing for about 10 years. And then a few years ago, I served on the board of Women in the Boardroom and became much more aware, sort of like the, what's that phrase, become an educated consumer. I became a much more educated consumer about how women-led funds, minority-led funds, and women investors and women on boards can make an organization be much more profitable and less homogenous, and the return profile is really interesting. And we just see statistics all the time about how more homogenous firms do better. And so I think that doing well and doing good go hand in hand, and we can actually do well while doing good. In addition to my role at ShareNett, I'm an advisor to a single family office in Utah that is very active in the impact space. And I'm also on the board of University Impact, a donor advice fund that is student-led and run.
Thank you, Marcia. We also have Jen Kenning, your friend and the co-founder at Align Impact, previously in wealth management and with many accolades in the wealth management industry, including 40 Under 40 a couple of years ago by Private Asset Management. That award would have been a long time ago for me if I had won that award. So very impressive resume you have, and Align Impact is looks like a very, very exciting organization. So tell us a bit about how you built Align and what your goals and initiatives are at the firm.
Great. Thank you so much, Kevin and Adam and Marcia, for having me, and I'm glad to be a panelist with Rob. So I actually built Align so that the world would work for 7.8 billion people, not at the expense of the planet. And I believe that investments and how we invest is actually the greatest tool that we have. I spent the first 13 years of my career in a traditional Wall Street wealth management family office role, leading families and their asset allocation, their philanthropic endeavors, their wealth transfer planning, to serendipitously go on this journey over a decade ago with two of my families in the 2008-2009 crash. We kind of started really diving into impact and really looking at it. This was, a decade ago. It was long before it was commonality. I like to say everyone is an impact investor because every investment has impact. And this for me is deeply personal. I believe this is really critical, not only to where we are today, and I'll talk about that in some of my comments throughout the panel, but I believe that families, technology, and investors, really family offices, have a huge, enormous amount of power to be able to do something really special and really great that can catalyze us over the next decade, 2 and 3. And what we invest in today actually matters. So Align works with over 50 family offices, families, individuals, and foundations, as well as institutional and firms, to help them build out their impact strategies and to deploy those strategies across asset classes. But most of our work is in the private markets. We also help them engage around their philanthropic efforts and how do you use multiple levers in order to drive that change. So I'm super excited to be here and excited for this panel.
Great, nice to see you again as well. We know that the ESG market is exceeded 30 trillion or 40 or 50 trillion soon. It's quite large, and as you said, BlackRock and other leaders are not only personally interested, but also required to be expanding their investments in impact, while also corporations are increasingly incentivized or required to embrace various ESG and CSR activities. So it's quite a large market, and of course essential that private markets and corporations do not rely upon the government alone to provide the most effective paths for our world and impact in ESG matters. So let's talk a bit about the trends in the market. What are you interested in? What are you focused on in ESG and impact, and how are you driving that forward in your organization? Rob, let's go back to you for the Living Fund and your predecessor, Micah Partners, and the 15 or 20 investments you've made. What really drives you in your investing methodology, and what do you think are the most important areas coming up in the market?
Sure. So I start off with a viewpoint towards a balanced health, emotional health, the food we eat, the sleep we get, the exercise, the community. When I look at what's going on in COVID, a lot of those things are being taken away from us. And but I view, for example, COVID is also a symptom of the illness, which is the people most impacted are the people without means and who also have at least one, if not two, chronic illnesses. So I'd say the big driver for me is I see tons of 1% solutions, and they're great, but I don't tend to invest in those. I tend to invest in businesses that I see, I use Parsley Health as an example. It's a functional medicine practice, started out of New York City. Now they're nationwide. In part, they had some good luck and fortune to have a bunch of capital before COVID hit, but so they're doing telemedicine around the country, looking at the root cause of illness. 5 years ago when I made the investment, it was about a 1% solution that could be brought out to the masses. And the big opportunity, besides being nationwide, is that insurers are going to start to look at doing in-network reimbursement. So when I compare apples to apples, a functional primary care doctor versus what we probably most of us have grown up with, which is pills and procedures type doctor, it's a no-brainer for me that this is a better solution. And if it's also more affordable, or at least on par, then again, I think it's the answer for healthcare. When we have a battle over who pays for healthcare, I think the way we're doing it today, it doesn't work. It'll bankrupt whoever is that payer. Even if it's the U.S. government, it'll just take many more years to do it, but it eventually will. Or maybe we already are. But if we start looking at lifestyle and how we eat and live and sleep, and give solutions to these people, including ourselves, then we have a chance at doing what Parsley's done, which is reduce prescriptions in their patient population from 3 to 1 on average. And that's real savings and real health benefit too.
You noted in your comments to me earlier that the annual costs, direct or indirect in healthcare, lost employee productivity for health is around 3.5 trillion. That's about 15% of the GDP. Why don't you walk us through your thoughts on that and how we got there with the food pyramid, and sort of what your knowledge and ideas are for nutrition, considering you're involved in some organizations like the American Nutrition Association, the Glasswell Syndicate. Like, what are your thoughts on the food pyramid and where it's going, and how we can expand, affordable, quality food, organic food, and so on for people's health?
Sure, that's a great question. Bottom line, I feel that the food pyramid has moved in the right direction, but is not there yet. And I look at it it's a very personalized, customized world around healthcare, and everyone reacts differently. But generally speaking, lots of carbs and processed foods are not great for the human body. And so I think the food pyramid is a little too directed towards those solutions. What I'm investing in today is a lot of personalized solutions, which is devices and or software that helps to track what's going on with the individual. Are they dehydrated? Are they getting enough sleep? What kind of food are they eating? Are we getting exercise? And when you combine that with genetic markers and really more advanced blood testing and saliva testing and breath testing, then you're going to have an answer. You're going to be walking around with your phone with the answer. So it basically democratizes this information. It takes it out of the hands of people who are controlling healthcare and telling you how we should be spending the dollars, and giving it to the consumer who's saying, okay, wait a minute, here's another solution, and I may not have to take medications for this solution. But just like the food pyramid, it does take time and slow incremental steps. And that's why I love participating in this, because as Jennifer mentioned earlier, it is impact, it's all of us together.
Thank you. It is, I agree with that. Marcia, why don't we move over to the gender side and women-owned businesses, both as owners and also investors. You've been part of boards with me and others that are seeing the progress, the slow progress towards better balance in gender matters for backing CEOs, broader access to wealth for angel investors, family office investing, and also board and governance participation with regards to women leading businesses. I personally see women making a lot of inroads in consumer and luxury commerce and digital side, but there's many industries where that's not the case. For example, Jane at Citibank was finally a pioneering moment of her joining soon the CEO role at Citibank is a huge movement in the financial services industry. So since you come from consumer and digital and now moving into the family office market with Cliff and Pallotta at ShareNett, what are your thoughts on how the gender context will evolve? Where does it stand now? How much farther does it have to go? And then tell us a bit about what your initiative is at ShareNett.
Great, thanks, Adam. Yeah, a real eye-opener for me a couple of years ago was one of the top women's cosmetic companies announced their first female CEO in 85 years. And for me, that was a real eye-opener because I thought, how did I not know that? How did I not know? Had I never thought that there wasn't a female CEO at the top of the cap stack there and who was leading the company. So I come at this partly on two different sides, one both as an investor and secondly as a consumer. Women drive a lot of the products that are purchased in this country, and I think that if we banded together and we decided that we were going to systematically boycott different companies that didn't have a female CEO, I could imagine that within 3 to 6 months, there would be many more female CEOs at companies. So I think there's that part of it is really just educating ourselves and being smart about where we're putting our consumer purchasing dollars as well as where we're putting our investment dollars. I think that's really, really critical. On the investing side, as I said, I sat on the board of Women in the Boardroom, on the board of University Impact. I recently put together a conference called We Rock, WEROC, for women entrepreneurs realizing opportunistic capital. This is a Utah accelerator that's part of venturecapital.org, and really interesting to see these women who are coming together. Many of them, as you said, are doing consumer products, but I think technology has made a huge shift in how women and minorities are able to produce different types of businesses and create businesses that answer a need for their personal communities. So I'm seeing a lot of things that are femtech related. I'm seeing a lot of women in healthcare tech related, even ed tech. Those are all things that women and minorities are saying we have been left out of the conversation. We even see it now with the drug testing and the vaccine that's coming out of coronavirus and how different communities are being hit differently. So how do we address those different communities? And so I think the best person to lead the answer and lead that charge is someone who is of the community. So I really am passionate about supporting women and minority-led businesses. As far as Change the Room is concerned, this actually at ShareNett had a conference last year, and there were 100 people in the room, and there were 5 women. And the CEO looked around and said, wow, we really have to change the room. And that's how the title came about. So you have to be proactive. You have to be reaching out to people. You can't just call on the person who sits next to you who's currently serving on your board. You have to be proactive in reaching out. And even for this panel, Adam, you were so gracious to reach out and ask me for some advice of some potential people that could be on this panel or other events that you and I have participated in together. So I think there's just I think reaching out, being proactive is really, really valuable. As far as the things that I'm looking at, absolutely looking at some women-led funds, looking at how women invest and what they are interested in, and then also looking at co-investing in some of the deals that these emerging fund managers are investing in. So expanding our investment opportunities in women and minority-led funds and businesses.
Okay, sounds great. I'm sure that as ShareNett continues to grow, there'll be more news on the website, through your newsletter, through LinkedIn as you build that franchise.
Thank you.
Clearly, the stats are improving and evolving. For example, Fortune 500 companies, women are around 7% of CEOs. VC, there's about 4.95% of women that are in VC positions, but only 2.4% are actually in control positions. So if we think about ESG, which is not just environmental and the climate, but it's the social fabric of organizations, of leadership, fiduciary governance of the organizations, and of course governance as well. We know that not only are women essential to understanding their own customer, but also being part of the social and employee and leadership fabric of any company. So I think that's particularly important for private companies as well, because public companies tend to get a lot more exposure and heat for them to be making change. And there's 6 million private companies versus 6,000 public companies. So that's also important to keep in mind. Jen, you're building a very unique advisory firm, consulting firm for institutional and non-institutional investors around impact. How did you bridge from wealth management, more traditional wealth management, into this niche area really a bit early on? And what do you guys actually do at Align? How does that work for you and your clients?
Yeah, and I'll weave in some trends that we see. The bridge was actually quite easy because I believe that your traditional financial planning, asset allocation, how we invest is the architecture framework for an impact strategy. It's really no different. We're just going 1 or 2 steps deeper and looking under the hood. So if you take the fundamentals of finance, you would never build a house without having an architectural plan. You're doing the exact same thing when you're looking to kind of migrate over to this arena where you're taking in other factors, where I actually look at them as risk mitigators, similar to what Robert was saying around let's be proactive instead of reactive. We had 12 to 13% food insecurity in this country before COVID started. That is terrible stats for the most developed nation in the world, that our own people can't even get access to food, right? It is a distribution, supply chain, access to information issue, right? So Align really is an educator. We educate and work with our clients on how to decipher what they really care about, 1 or 2 things, and then how to go about implementing that across asset classes. When I think about some of the things that Rob said and Marcia said, 2 of those themes are the biggest trends we see. One is food and ag, and I'd also include regenerative soil, right? Our soil health impacts our animals or our plants, impacts the food we eat, impacts our health systems. That impacts how we get food from the farmer all the way to the inner city or to rural areas where people are actually living in food deserts in the United States. Almost 20% of our children before COVID were living in a food insecure home, right? That impacts their health, that impacts their education, it impacts their brain development. All of these things are interconnected, which leads me to my second trend. Everything is interconnected. If we don't know that now, having lived through COVID the last 9 months, we are an interconnected global economy, supply chain. What we do on the East Coast, the West Coast, London, Europe, and the Middle East impacts everyone. So we're no longer in a system where it's I and me, it's we and us. We're all either all boats are going to rise together or we're all going to go down together. And I'm actually, like Kevin, an internal optimist. Anyone who knows me knows that I believe this is how we will invest in 10 years. And this will not be a different type of investing. This will just be good investing, right? The third trend I see is a trend towards breaking down the silos. We are starting to see environmentalists become socialists. Socialists become environmentalists. because all the issues are interconnected, right? Women leading the charge or being at least in the room or in a C-level position to make a decision or leading a company or a fund impacts what kind of products and services get to the marketplace, right? I see gender, I see people of color, I see us breaking down our unconscious biases that exist for 100 or 400 years, depending on which way you want to look at it. And that all of these things are really interconnected. And so it is about saying, if you're focused on the indigenous people, you're also focused on the climate injustice that they experience by not having access to renewable energy or access to affordable energy, right? There isn't one area that we've seen over the last 9 to 12 months, and we've really seen it over the last 5 to 10 years, where we don't need systems change. We need system change in our education and how it's delivered and the content of the education and educating us around our food, well-being, health, sleep, and around inclusivity and breaking down on biases. We have a systems change that's needed around health that Rob's already spoken on. We have a system change that's needed around economic development and empowerment and leveling the playing field. And we need a huge systems change around climate change. So if you think about where we are in this moment in time, it's a perfect storm of 4 crises coming together. But I actually see it as an opportunity, and as an opportunity for investors to really educate themselves and get power. Education is power around what private investments they can make today that are the public companies in 10 years and are the game-changing solutions that actually revolutionize where we are in 10 years, right? I said in my opening remarks, what we do at Align is help them invest in things today that will impact us 5, 7, 10, and 20 years from now. And we've had no better opportunity. We have strong systems that were built, right? Now we need to evolve them into stakeholder capitalism, and really holding our business leaders to account. I'd like to hold Larry Fink to his comments because he only votes 1/6 of his proxies and shareholder votes around social and environmental issues. I like it to be 100%, right? We got to hold public companies accountable. We got to empower and build private companies so they can be the public companies of the future. And we got to create an inclusive economy so that everyone thrives. And that's really what we do, is help families and institutions make those decisions so that they believe that they can invest in world-class solutions that drive the change that they want to see.
Thank you for
And
that.
I'm not that passionate about it, so
Yes, of course.
as you can tell.
Well, thank you for that. We could have another panel just on the passion side as well. Let's go around and talk about the issue of measurability and how to frame as an investor, as a GP, or as an LP, how to think about the framework of direct and illiquid impact investing for a longer time frame, 3, 5, 10 years, and what type of framework and variables you guys think about applying to such investing on the food and wellness side. Rob, why don't we start with you for a couple of minutes, and we'll go over to the other two. Sure.
Thanks, Adam. As an investor in early stage businesses, it's one thing to find a business that I think is doing the right kind of impact. But then there's the other side, which is the capitalistic side, which is, can they also be effective at what they do? My investments are in healthcare services, digital therapeutics, technology, education, as well as consumer products, including food and skincare. There's emotional health and mental health. There's a number of different areas, but truth is, in every one of these sectors and every one of these niches, there's 10, 20, 50 entrepreneurs, if not more, that are really digging at the solution. So it's one thing, okay, well, I'm trying to figure out the solution. They still may not win in the end to bring these solutions. There's a lot of factors and a lot of variables. So what I try to find is a CEO and management team that has the ability to raise money. They somehow are able to communicate their thoughts in a way that people want to invest. Their ability to pivot. I like finding businesses that have failed, and then hopefully I can get in right before they succeed, because in failing, they learn how to pivot and they show that ability to pivot. Every entrepreneur has to pivot at some point. There's a thought about a sector, an opportunity, and then all of a sudden a law changes or a competitive environment changes, or the consumer just says no. And then they got to figure out how to get to yes. So most of my time spent with entrepreneurs is just sort of a get to know you kind of conversation, because it's going to be a 10-year horizon for most of these investments. And so I want to get to know that person, not just their idea, how they think, how they live their lives, what makes them tick.
That's good. I love the name and the idea of the living fund and how you can be investing to help people's lives. Great name. And we'll be seeing more about your living fund in the near future as you're raising your fund. We'll come back to the end of the panel with regards to what your hot buttons are right now. Marcia, on the gender side, it's a bit tricky for people to really understand, to get involved, to make a change in getting in the room, particularly if you're not a woman, or if you don't have access to that talent, or you don't have people around you that want to make that change. So, you know, as an entrepreneur, as an investment banker, but also as a principal, what type of framework are you putting around, you know, sourcing that talent, backing that talent, and then how do you think about creating the corporate or the cultural environment so there's harmony with more women in the room?
Absolutely, thank you. Well, you know, 10 years ago, I don't think there were as many organizations as there are now that support women founders. So there's great resources now. Many of them started by college students who were, who said, wow, I want to be in the room. So many of them backed by their parents. So as a parent if you have a daughter, you probably are more aware that her options might be limited because you see what's happening for your daughter in the workforce. So I think there's partly this awareness as a parent when raising daughters. But I really do think there's great organizations like 37 Angels, Female Founders Funds, 100 Women in Finance. There's terrific organizations out there that are really trying to bring people together and especially raise awareness around ESG and gender. There's a great nonprofit organization called parity.org, whose only mission, their mission started to make sure that companies would give a pledge to interview at least one woman for every VP and above position in their firm. It wasn't they had to commit to it, but they had to change the room. They had to change who they were looking at, because so many times people throw up their hands and say, oh, I don't know any women. I don't know any funds. I don't know any. That's the first phrase. I don't know any. But there are no excuses these days to not know any, right? I think there's great opportunities to find these organizations. So I think there's some terrific accelerators across the country that participate in supporting and mentoring women, I think, and minorities. I was talking recently with a friend of mine who's African-American, who spent 30 years in corporate America. And she said, it's not a glass ceiling, it's a brick wall. So she said, do you think if you just talk about how hard it is for women, they make it much harder for minority women to get ahead? So how do we get those women and attract those women into the room, people of color? So one of it, I think, is they have to see themselves in the room. So this is fabulous. We're 50% here, Jen and I, on this panel. So I think that's a higher statistic than most rooms. I think that being proactive to invite BIPOC, women of color, diverse people on a panel, invite them to participate. That's one of the first phases. How do you invite people to participate so people see themselves in the room? They're more likely to say, oh, I could do that too. And then I think the second thing, and a lot of things that Rob talked about, is that finding a team. Certainly, if you find if a minority-led fund that has raised money, I would absolutely put more money behind them, because they have to work 50 times harder, and I'm making up that number, but they had to work significantly harder to get there than somebody else. And so that's the kind of fund manager and the kind of CEO that I really want to back. But I also like being an advisor to them and helping and support them and using my network to help them expand their reach, because Jen commented on this, all boats rise with the tide, and we can absolutely support each other and help each other get to where we, this fabulous future that is ahead of us.
Great, thank you. And Jen, briefly, what are your thoughts on how you distinguish between just do good philanthropy investments versus more of the Bill Gates model, which is more, has a for-profit overlay on top of the philanthropic mission?
Yeah, I think we need all types of capital, right? We need to use different levers, and we need to put the right type of capital where the capital is needed. So in some of those earlier stage companies that maybe start as a nonprofit and move to a for-profit, and maybe it's a first-time entrepreneur, we should be using philanthropic capital to de-risk the opportunity, to really give them that patient capital to excel and to prove out their model and to pivot and to pilot and to kind of get the kinks out. And then we should move to more traditional investment capital. And so I think when I mentioned levers in the beginning, and I'll use this as my closing remarks, it's really look to see kind of what are the different levers that you have as an LP, as a GP, as a family, that you can use to enhance the system, right? One of your levers, maybe you have a significant network that you're able to make those introductions and really expand that entrepreneurs or that fund's kind of growth projective. One of your levers may be that you have 30 years of corporate law experience and you might be able to assist from a technical perspective. And then another, maybe you have different buckets of capital that have different risk appetites that are really trying to drive change in a different way, but together they work to really drive the whole system forward. So I'd really challenge everyone from a GP to an LP to a leader of an organization, look at your different levers and how you can actually have impact beyond one lever, and how you can incorporate the E, the S, and the G to really mitigate risk and to drive future returns.
Thank you. We'll wrap up with just a 30-second with each of you. What are you most passionate about now, and how can everyone on the call here be involved or participate in your organization? Rob?
Sure. I'm in the midst of raising a fund. I'm hoping to close Q1. I've made 15 investments to date. I'm going to contribute some of those investments into the fund. Fundraising is going well. You can learn more about what we do at living.vc. And from an investment perspective, I'm most excited about, I alluded to it earlier, is devices that help us track our individual data. We are early days. Some of the devices like Aura and Fitbit, those are first or second generation. In a few years' time, it's amazing what we're going to be able to do by tracking our breath, our urine, our blood, our saliva, with a variety of types of devices that will be also affordable and available and hopefully reimbursable.
Thank you. Marcia, how about you?
So I am starting a newsletter, a monthly newsletter for ShareNett, the new company I'm involved in. And each month we are highlighting a women we're having to change the room spotlight. So I'm actively looking for women. And of course, I'm going to add Jen to my lineup, but I'm actually looking for female investors and minority investors and female-led funds and business owners that we can spotlight each month and actively promote them and into our network and help other people learn more about them. So that's really my next phase, and that newsletter is going to be coming out in January. So very excited to be working on that. For people who want to find me, I'll just mention I'm on LinkedIn. Adam knows I'm pretty active on LinkedIn, so you can find me there. That's probably the easiest way to connect with me. And I'm certainly looking forward to talking to other people on the panel, but also anybody who wants to have a conversation specifically around Change the Room and how we can support women-led and founded businesses.
Thank you. And Jen, lastly, we know how your organization works, but let's say, we're an institutional limited partner. How do you work with clients these days and differentiate those services for them?
Yeah, So Marcia, I have lots of ideas for you. Happy to throw them your way. There's a lot of information on Align Impact at alignimpact.com. And it really talks about how we work with each different type of partner, what kind of funds, direct deals, and other things we're looking for. So there's a breadth of information there. We put out a newsletter, usually twice a quarter. One is on a topic and one is actionable. There's lots of great action items around climate and social and racial justice if you look at the stuff we put out since May. And you can also find that on our website. And you can subscribe to that as well. And then I would leave you with, if I could empower you to do one thing, it would be look to see what one lever you can add to what you're already doing as a takeaway from today's session, so that together we can really drive this forward, because it really does take action beyond just talking about it. And I think if we collectively looked at what's the one thing we can each do to add an additional lever to our why, the world would look radically different. So thank you for having me.
Thank you. Nice to see all of you. Hand it back over to Kevin.
Thank you very much, Adam, and to all of you as speakers, and certainly cheers and hear, and Slandra, and whatever you'd like to say to Jennifer's comments. We all do need to work together as a community, and I think we're making progress, moving in that direction. So, all of your expertise is evidence towards, the good people that are working towards it. So it's time to move into our next panel discussion. And before that, we'd like to feature a deal that represents the money-making aspirations of many investors simply seeking profitable deals that do support products and services that will eventually improve the world we live in. On that end of the spectrum, and then we'll have our panel, and then we'll actually wrap up with charity focus on the other end of the spectrum, which is not expecting anything back. But we need both ends of the spectrum to work so that it's sustainable as a strategy. With that, I'd like to say that Daniel Laurie is the co-founder and CEO of Udelv, a company pioneering autonomous delivery. In January 2018, his team actually, with his engineers, orchestrated the world's first public road autonomous delivery in California. And in 2019, after releasing its second generation vehicle, Udelv successfully completed more than 6,000 automated deliveries on behalf of a variety of retailers that include Walmart in Phoenix, Arizona, and XL Parts in Texas. Prior to Udelv, Daniel founded and ran several companies. He's no newbie here, including Geary LSF, the fourth largest US independent digital marketing agency, and LuckySurf.com, the world's first online lottery, which raised 40 million in funding and successfully sold in 2008. He started his career as an investment banker with Brown Brothers Harriman, and he's an investor in tech through his VC fund, the Explorer Group. And he's chairman of Homelessness, a nonprofit organization he created in San Francisco. And so with that, Daniel, you can start sharing your screen here and take it away.
Thank you, Kevin. Can you see my screen now?
Yes, that is coming live. Yes, thank you.
So thank you very much for the kind and generous introduction, and for your invitation to be on this panel this morning. Transportation is about to undergo the greatest revolution in more than 100 years, and it's the result of two things. One is the advent of electric vehicles, and the second one is the advent of autonomous vehicles. And when those two are combined, we're probably going to be seeing something or vehicles on our roads that are going to be very, very different in the near future than what we've known for the last 100+ years. McKinsey says that within the next decade, 80% of deliveries will be autonomous. And I added clean by 2030 if you combined autonomous vehicles with clean electric platforms. Autonomous delivery will forever change logistics. because it will save on driver expenses, and it's not just the cost of labor by the hour, but it's also all the other costs of managing teams, insurance, workers' compensation, police tickets, etc. It will be clean. It will be on electric platforms. It will be ubiquitous and available 24/7, and it will be data-driven, which will make it a much more efficient service for everybody. So in this context, Udelv's mission is to reinvent delivery and to power the hypergrowth of commerce. The problem today with logistics is severalfold. First of all, we are facing a significant driver shortage that is projected to triple within the next decade. The American Trucking Association estimates that the driver shortage by 2022 is going to be around well over 100,000 drivers. And if you add this to the last and middle mile delivery driver shortage, you're probably around 150,000. And this is only going to go up as growth in e-commerce and commerce in general continues to expand. Labor costs already represent about 65% of last and middle mile delivery. And if the driver shortage continues to happen, you can expect that those labor costs will rise way more than inflation. Of the 5 biggest issue facing trucking industry, the top 3 are related to driver issues. We talked about driver shortage, but there's also hours of service, overtime, driver retention. And so finding a solution to remove the driver from the equation will be very good for the world. At the same time, drivers are of delivery trucks and last mile delivery trucks are involved in are responsible for a lot of the road accidents. And if we can make our roads safer, it'll be good for the world. And finally, transportation represents nearly 1/3 of total US greenhouse gas emissions. So if we can replace ICE engines with electric platforms, we're going to save on that. There is a study that shows that e-commerce and bulking delivery in it by itself help us save about 40% of greenhouse gas emission versus people doing individual shopping. And then if you replace the ICE with an electric platform, you can save another 50% of US greenhouse emissions for transportation, which is combined a total of 90% removal. So because this is such an important aspect of the next decade, because this is such a big revolution that's going on, there's been many creative ideas in the last couple of years or 3 years around how to create an autonomous delivery vehicle. But those ideas, while very creative, all of them being very creative, they fail to capture the complexity of reinventing delivery and automating the driver journey. It's going to be, if you like the image in the middle, for example, has a very beautiful design, but how are you expecting that people will get into this vehicle and try to find their package? The one on the right-hand side is a neat idea, but is it going to be working technically? How are you going to maintain heat or cold temperature on a small vehicle that is also running on battery? How are you, is it really a good asset utilization to have a small vending machine on the street? Are you stacking packages as the image in the middle? Are you doing fixed lockers on wheels where you may not be able to carry some of the goods or maybe carrying air instead? So all these ideas, while very, very neat, fail to capture the complexity of reinventing delivery. And that's what Udelv has been working on of the past 3 years, which is how to automate the delivery journey workflow. First of all, you have to carry a lot of different size packages. If you're going to be carrying pills for Walgreens, or if you're going to be carrying auto parts for an auto parts distributor, you need to have a system of shelving that allows you to carry multiple sizes of or multiple dimensions of packages in the same cargo space. And Udelv created and invented what we call the U-Pod, a pod that allows you to carry multiple dimensions of packages. The second thing is, how do you automate this journey, which is very, very complex. There's the workflow goes from remote waking up the computer in the morning, turning on the ignition, diagnose the health of the engine and the sensors and the compute equipment that's on the vehicle, going to the merchant and have the merchant being able to load automatically the vehicle, then sending off the vehicle on the customer route, have the customers be able to unload packages without taking somebody else's packages, going back to the merchant, reload, repeat the process, and then finally go back to overnight parking and turn off everything for the night. So this is a very hardcore engineering problem, and this is part of the revolution that we are pioneering here with the Udelv OS. The technology that we created to get there is lying on 4 pillars. One is this delivery management system that I was referring to that automates the workflow. The second one is what we call the U-Pod, which is a system, a patented system of adaptive shelving that allows you to add or remove shelves depending on the size of the packages that you're going to be carrying, and has this very innovative adaptive aperture mechanism with a horizontal and vertical shutter that allows you to create any type of rectangle that you want, and it's all software controlled in order for people to retrieve their goods and not somebody else's goods. It is on the autonomy side, there are 2 major pillars. One is our telematics system, which allows us to monitor and control vehicles thousands of miles away from the base, and be able to take control of the vehicle from our command and control center, and actually drive the vehicle thousands of miles away. And it looks really like a video game, except it's the reality. And finally, there is the delivery specific autonomous driver that we created in order to drive on public roads. So that's a glimpse at the technology. And but how does the transportation vehicle of the future actually look like? And if you think about it, has to be clean, but it's probably not going to look like anything you've ever seen on the streets before. Because if you think about it, and you have an autonomous transportation vehicle, you don't need seats, you don't need seat belts, you don't need a cab. You just basically need an electric platform and the Udelv pod on top of it. So here is a first glimpse at what—
Pardon me, Daniel, I want to leave this image in their mind, burned as a teaser as to all the questions they could potentially ask you. We are running out of time, unfortunately, and I did have one question perhaps you can answer before we move into the next panel. I don't want to cut anyone off here on their panel time. So how many more years do you think it will be before autonomous vehicles like this and others are the standard in the US and the rest of the world?
It is going very fast, Kevin. We will be removing the driver on our first routes by the summer of 2021.
Okay, and I've had some back channel questions about the way that you're taking advantage of the existing infrastructure and so on to make money now, rather than waiting until, you know, some future plan like Waymo or others may have, to be able to completely eliminate drivers and navigate tricky urban environments and so on and so forth. So there's a lot to talk about here. I understand why it was tough for you to squeeze that all in, but I will need to move on to the next panel, and I'll help some folks to circle back to you. Thanks so much, Daniel. Moving on, I'd like to hand off next segment to Jonathan Lacrosse. He's the founder of Lacrosse Investments 37.4. And Jonathan has a unique perspective. It's always valuable. He put over $4 billion to work as an LP with Robert Wood Johnson Foundation, and then with CalPERS, where he launched Centinela Capital to focus on emerging managers. And since then, he's raised over $4.5 billion as a placement agent. And that's the nature of Lacrosse Investments 37-4, where I've recently joined. We had a history working together, doing road shows for some of his private equity and venture capital clients, and now he's expanding that team. So I'm very pleased to be part of that. And we're just leveraging mostly on his experience, frankly, and bringing more capacity to that. So Jonathan, with that, if you would mind sharing any other details and introducing your panelists.
Great. Thank you so much, Kevin. Appreciate this and appreciate the opportunity to speak once again. So yeah, I've been in and around this ESG for a long, long time. Actually started over 25 years ago at the Robert Wood Johnson Foundation, which is the about $11 billion foundation solely focused on healthcare here in the United States. And I started there on the grant side, and we were making program-related investments in and around healthcare. So, and then moved over to the investment side. Well, you know, we had one policy there that we couldn't invest in anything that was alcohol, firearms related, tobacco related, and we would actually get a side letter from all of our private equity investments that we made. So this goes back a long time, and then transitioned into running an emerging manager program 13 years ago with CalPERS, where we raised $1 billion, and the emphasis was on minority and women-owned firms. So this is certainly near and dear to my heart, and probably the largest group that we've raised money for is on this side is a woman-owned firm. So with that, I'm going to turn it over and be the moderator here and get some great LP perspectives from Ami Samuels and Alex Lamb. Let me first introduce Ami, and then he can give a little bit on more of what I didn't touch on and his views on ESG. So Ami is a partner at Gatewood, and he plays a key role in transaction origination, execution, marketing, and portfolio management. Prior to there, he was co-head of the private equity group for a subsidiary of the Bank of Hapoelium, which is a financial institution out of Israel. And Ami has a long history in investment banking and in private equity. If I read his whole bio, we might be here for a few minutes. But yeah, he is well trained at Yale and then at a university in Israel and with the University of Michigan's executive program. And I think I recall that he leads the ESG policy there at Gatewood. So Ami, with that, why don't you fill in what I might have missed, give us a little bit more overview of who Gatewood is and your views on ESG as a starter.
Sure. Thank you very much, Jonathan. Appreciate it. And it's a pleasure to be here today. Gatewood basically focuses on anchoring and seeding emerging managers and other funds exclusively in the private world, so private equity, private credit, real estate. We act as an anchor investor in a first closing, so very early institutional investor. And we form partnerships with the GPs that we work with. We're pretty much, opportunistic, and we look at almost everything. We don't currently do very early stage venture or biotech funds, but we do pretty much everything else: private equity, growth equity, distressed, special situations, infrastructure, private credit, real estate. And in that vein, basically, when we look at a manager, we look at a lot of different things. I am responsible for ESG. The whole firm is quite focused on it. And every single manager that we do a deal with, that we see, we anchor, they adopt a very robust ESG program. it's either our own ESG protocol program or something that's, basically that fits for their investment program. But it's a requirement of ours, and we place a lot of importance, not just in the investment itself and the underlying manager, but how they relate ESG factors into their own investment program. So there's sort of a ripple effect. We've been doing this for a long time, as you mentioned, both at the bank and then since 2015 at Gatewood. Over time, this has become more of a sort of center of the fairway kind of consideration for many LPs and for many GPs as well. Although I have to say that in the United States, I think this particular topic may be behind Europe. This is one area where Europe is very advanced, so we can talk about that more. It's not just the environmental considerations or minority issues or women issues or governance issues. It's really a very specific focus on how to make investments that have an impact, that make the world a better place from all of those aspects that we talked about, and to make investments with, the kind of strategy that will make investors money. And there have been a lot of research projects which we can talk about that actually show that if you're cognizant and very conscious of these aspects, potentially you can make even better returns than if you don't pay attention to these issues. So I'll stop there. I know you want to introduce Alex as well, but we'll talk more about these topics.
Great, thank you so much, Ami. That was excellent. Next, I'm going to introduce Alex Lamb. Alex is the lead managing partner at New Summit Investments. He co-founded New Summit's Impact Strategy and is a member of the fund's investment committee. He has a decade and a half of experience with ESG and a lot of considerations here. Previously, he was at E&Y. He worked with corporate and investor clients there on the integration of impact and ESG. He also, you can talk about how you partnered with Newsweek and your inaugural Newsweek Green rankings. I think that might be fun. He's got extensive education background as well, from Hampshire College and Pinchot University, an MBA from Pinchot University. So with that, Alex, do you want to tell us a little bit more about yourself and New Summit Investments and your strategy around ESG to kick things off? That'd be great.
Absolutely. Yeah. Well, good morning, everyone, and thanks for having me. So again, Alex Lamb, I'm a managing partner at New Summit. New Summit develops and manages private market impact fund of funds that target solution-oriented strategies, aligning with the UN Sustainable Development Goals, but really across three pillars, that we target: equity, health, and sustainability. We work with institutions and individuals. Often we work through investment advisors to help their clients get vetted, diversified, and repeatable access to the space. We currently work with about 17 managers, including well-known and established players like SJF and Jonathan Rose, and then emerging leaders like Clean Energy Venture Fund, the Builders Fund, Axion Frontier Inclusion Fund, probably names that folks on this call recognize. Like Jonathan said, I've worked in this space for most of my career. I really wanted to do private market impact investing out of business school. Unfortunately, it was still in its infancy. So I did spend, fortunately, I got to spend, the good first half of my career in ESG, first at KLD, which was really the first ESG and index shop in the space, now part of MSCI, continued at Trucost out of London, now part of S&P, and then, like Jonathan said, spent several years at E&Y. And then in 2015, really had the opportunity to partner and co-create with 3 registered investment advisors, this first of its kind fund of funds in the impact space. In 2016, we started New Summit really to offer the strategy more broadly. Fast forward to 2020, the end of 2020, we've almost fully committed our second fund, and we'll plan to start committing capital out of our third fund early next year.
Well, that's great. Thank you so much, Alex. I'm going to start things off maybe a little bit controversial here with the first question. Ami, I'm going to gear this to you. As we recently passed the 50th anniversary of Milton Friedman's essay on shareholder theory, which said that corporations' role is to maximize profits and not other social responsibilities. So as we hear, the passion from the first panel, and today's whole theme is around ESG. Is this a fad, or will we go back to Friedman's focus on profits only? Why or why not?
I don't think we're going to go back 50 years. I think 50 years ago, nobody knew about global warming. And I think women barely had the right to vote, not to speak of other things. And technology was nowhere, even close to where it is today. We just saw a presentation about, autonomous vehicles and basically what's pushed the market to 30,000 are the big tech companies and some other technology-oriented things. And what will get us out of the pandemic is a vaccine that's been developed in less than a year. So I don't think we're going back to 50 years ago that the only thing that matters is profits. Even investors, when they're investing in a company or in a fund or in a private situation, they ask themselves, is this investment something that aligns with my moral values? Is this investment making the world a better place or a worse place? And you talked about, at Robert Wood Johnson Foundation, not investing in ammunitions or, whatever it was that you had in your policy back then. It's developed a lot further than where it was, and today I think that we're seeing even though the people who say that the world is not really warming up, or the whole thing is made up by scientists, most of the investment community today understands that we need to be very conscious of our planet, that we need to give everybody equal rights to succeed. Entrepreneurship is not just for men or for white males, or the right to be happy and to basically solve some of the issues. We've created a lot of problems in the world in the last 50 years, which we need to start working on solutions. And the private equity industry, private debt industry, every industry should be thinking very hard about how to work to make money, to be profitable, but to also be able to start solving some of these problems. And we're not going to succeed in all of them in our lifetime, but at least to start that, to continue some of the initiatives that are taking place in this area, we're definitely not going back 50 years, I think, Jonathan.
Any views on that, Alex, in addition to what Ami said?
Yeah, I don't think we're going to go back 50 years. I think we're going forward. I think if anything, the concept of the large asset owner as the universal investor is starting to become more mainstream. And so I think for very large asset owners, the idea of that externalities aren't going to come back and impact their portfolio is a thing of the past.
Well, I anticipated both of you guys saying that, but I thought I'd ask it. So, Alex, let's stick with you. So, given that this is here, it's here to stay. So, how do you impact and how do you measure impact for ESG and other measures of doing good?
Yeah, sure. So I have a biased view or an impact strategy. We see a few things as just sort of table stakes to qualify as impact. And so, there are a few things that we really like to look at that we now see as sort of the standard for how you evaluate, assess, and measure impact. And I always think it sort of comes down to three things, right? Intentionality, additionality, and then outcomes. And that might sound trite, but I think that these are pretty key indicators. So intentionality, we sort of look at the who in the thesis. Additionality, the level of contribution, the outcome, how much. Intentionality, I think, is sometimes too lightly used as a measure, but it's actually, when you look at private markets, quite important. It's a measure of where's the manager's head at. Do they see impact as integral to their investment thesis? And does the impact and investment thesis overlap in a way that's mutually reinforcing, right? So as one scales, the other scales. We find that impact reporting is often a really good way to measure that. But also equally important, and private markets are always a small space with a heavy network effect. So manager reputation, does mean something. I think that's a luxury that we have in private markets that maybe you don't have in public market analysis as much because of the space. I think the other thing that we look at, and I give some caution here for folks who look at this space, is how managers self-classify, because I think there can be some counterintuitive signal there as well. Certainly, we see a number of managers who classify as impact who maybe we would disagree. Not necessarily that they're impact washing, just looking to source capital. Frankly, if you're looking to just source capital that way, it's a lousy strategy. But that maybe it's not really impact. It's something that looks more like traditional SRI, avoiding harm, ESG, maybe benefiting stakeholders. In impact investing, what we're really trying to measure is, are these solution-oriented enterprises, and can we measure that? So we want to look for managers who are actually doing that. The other caution is we see a number of managers, and we invest with managers who don't self-classify as impact managers, right? Sometimes trying to avoid the perception bias that impact funds are concessionary and aren't market rate. So often we'll find that the managers in our space who actually do quite well financially don't classify as impact. We know from their intentionality and their outcomes that they are, but they don't because they think that it's going to be a blight on their ability to raise capital. So we're still in a space that's a little bit more art than science, but there is some science coming into play. So in terms of additionality and outcomes, we'd like to see more standardization in the industry. It's not there, but there are some best practices emerging. We really like to partner and work with groups like the Impact Management Project out of London, where, in terms of understanding outcomes, what's the scale, depth, and duration of the investments. And then there's a new program coming out of the Impact Management Project called the Impact Classification System. We partnered with them over the last year to look at our Fund 1 portfolio as they were developing this metric. And what that's designed to do is to look at investments on a scale of what they call the ABC of impact. So A is act to avoid harm, sort of the classic SRI approach. C is B is benefit stakeholders, where we would see sort of maybe the ESG framework. And then finally, it's contribute to solutions. And we really like that sort of framework to be able to actually look at an impact investment and say, okay, well, where does this fit on that spectrum?
I'm over here taking notes. If anybody had additional questions, I'm sure you can reach out directly to Alex, and he can help there. But let's turn it over to Ami. So Ami, you are seeding a lot of different firms, as you mentioned earlier. So what are some of the key criteria in the ESG that you're requiring these firms to have? That we have a number of LPs here on the panel today. as well as a number that usually listen to the recording. So what are some of the key things that they could be adding and putting into action?
Yeah, so when we, due diligence on managers, one of the areas obviously is ESG considerations, and we have a robust ESG policy ourselves, which we share with all of the managers. Actually, in our side letters, just like you described earlier, in our side letters we have a requirement that they adopt either the Gatewood policy, or if it doesn't fit exactly with their strategy, that they modify it and select and adopt an ESG policy which fits for their strategy. What we also do is we have an annual ESG survey where we send out questionnaires to all of the managers, asking them, first of all, to confirm that they are, actually, that they consider ESG considerations, that they write them up in the investment memorandums as they make investments, whether they, we track different metrics, employees at the various companies, the breakdown between men and women, if they report on minority employees, and then little things, as you mentioned, it's really hard to measure some of these things, but we ask if they're doing waste management and recycling at the portfolio company level. We ask if they're using any alternative energy sources. One of the managers actually installed a very large solar panel system on one of the properties. It's a real estate firm. And they got an upfront payment for this, and they're getting annual payments for the next 20 years. So it was a win-win. They're going to be using clean energy, and they got paid for providing their roof to this operator, this solar operator. So again, we're always thinking about numbers and how we measure the impact, and it's hard to do. If we were trying to find the carbon emission impact of, I think the virus had this huge impact of people not taking airplanes. But it's hard to measure, right? It's hard to ask managers how much carbon emissions do your portfolio companies produce, or how much did you save by taking certain measures. But at least these annual surveys bring it back to the forefront of their attention. We ask who is the ESG senior person and how they implement their program. And we're also trying to implement now at least twice a year, maybe more frequently, like ESG webinars on a particular topic to include some of the managers in that, to bring it more forward in their thought process about how they're managing their business.
So to follow up on that, and as far as your survey goes, have you been able to then create certain measures, or have you been able to create a benchmark? And how do you hold certain managers accountable that aren't following what you've laid out for them as far as ESG?
Yeah, so first of all of them have adopted an ESG policy, which is a good start. And we haven't formed benchmarks, but we're trying to work with managers. Again, they're scrambling, finding deals and working on execution or exits, and that's in the forefront of their mind, to make money for their investors. But we try to push them also in this direction of, if they didn't include ESG considerations in their investment memos, we said, well, we actually are an observer on the investment committees of these funds. So we look for that, and if it's not there, we'll ask him, what kind of due diligence have you done in ESG related factors, or why isn't it here in the investment memo? And so slowly things are beginning to be incorporated more and more as we go forward.
That's great. Alex, what about you? Have you guys come up with a benchmark on how to measure impact?
Yeah, so first I would say we do separate sort of our financial benchmarking from our impact benchmark work, and they're very different exercises. On the financial side, there are clear measures. We're a market rate focused fund, That doesn't necessarily have to be true for every impact investor. For us, that's the agreement we've made with our LPs. So, so we have to start with that sort of analysis, which is sort of threefold, right? We look at traditional measures. We do a ton of benchmarking analysis, and then we look at them compared to a very specific peer group. On the impact side, I would say that it's a very different exercise, right? We don't have the luxury and impact of having Cambridge Associates create a benchmark just for impact. We do for the financial performance of impact funds, but not on impact alone. So, what we rely on for impact benchmarking is quite a bit of peer analysis. We track a fairly large universe of managers. We try to put them in their appropriate peer group by asset class, by stage, by thematic area. And that allows us to, again, when we're doing our impact analysis, do get some benchmark information, which is really a measure not of what is good, but what is better, right? And so there certainly we would rely on the work that we've done. I mentioned earlier the work we've done with the impact classification system, the Impact Alliance work that's come out of the Impact Management Project. So many acronyms, so many names. But again, that does allow us to say, okay, well, if what we're trying to do in private market impact is invest in solution-oriented enterprises, and specifically take measure of what those outcomes are, can we look at one manager against another manager and say how much of their portfolio is actually contributing to solutions? And that might sound very vague, but you can actually, if you look at the underlying enterprises, what they do, and then look at one manager against another manager, what they've actually invested in, you can start to get a benchmark, an apples to apples benchmark for what's in those portfolios. But again, still very much of an art on the impact side.
Very, very helpful. Thank you. I know we are running over our time here. I see Kevin popping up on the screen. Kevin, do we have an opportunity for one last question for these gentlemen?
Yes. So why don't you wrap up with a final question? And yes, please.
Okay, great. One last question, if you guys could comment. How important are returns from your underlying investments, your underlying managers, versus the impact of investments and for your programs? So if you could weigh that in some kind of manner, that would be great. And any additional closing thoughts for the audience around this topic would be wonderful. Ami?
Sure, I'll start. So first of all, when we evaluate an investment, the first questions we ask, is this a good investment? Do we think this investment is going to be, not just making money, but also, a good moral impact investment? And again, not an impact investment just in the ESG kind of world, but is it going to make money? Back to your 50 years ago first question. But does it align with our values? And are the managers themselves, obviously this is a people business, are the managers good people, caring people, people who are going to do the right thing? And the right thing means different things to different people, but obviously, doing good and doing well, first of all, this has to be a good investment with good people, and then the other things will align. That's our bottom line philosophy.
Yeah, and I would echo a lot of that. And in the interest of time, I think I can give a pretty simple answer. It's important to us. We don't want to give up on either. And I think part of the weight that we feel on our shoulders is to be able to prove that in this space, that you don't have to give up return for impact. it does require some flexibility in how you construct portfolios and thematic focus. Certainly, if you have a very narrow thematic focus that may match a philanthropic program, you may need to give up one or the other. But I think given the right flexibility thematically, investors should be able to put together portfolios that don't give up either.
Thank you, gentlemen. I appreciate all your comments. If you want to learn more, these guys both have websites you can go to. I don't know if you just want to give the, your specific URL. That would be great in closing.
Happy to speak to anybody who has interest. Always a pleasure to meet new talented managers. Gatewoodcapital.com, amiS@gatewoodcapital.com. Happy to talk to you always.
And same here, newsummitinvestments.com. Always happy to have conversations and always looking to talk with interesting new managers.
Great.
Thank you. Thank you, Jonathan, and thank both of you, Alex and Ami, and everyone who is still remaining on, on the box here. This is our first time going over on time in the group of webinars that we've done, and I think it indicates part of what we're seeing among the answers on some of these questions, which is that there are no strict guardrails around some of these topics, and it's very hard to measure. It's very hard to put limitations and expectations, but directionally we're doing the right thing. And directionally we are here moving into a final set of presentation slides. Unfortunately, the charity that we decided to feature here was not able to join us in a live format initially. So we do have some slides with a few comments. I'm going to share that on the screen. And I would just say that this is a charity that is near and dear to Jonathan Lacrosse, who has helped support these webinar efforts as well as a webinar chair. And I know that our philosophy that he has built into our thinking is that we hope to make a lot of money so we can give away a lot of money. And this is one that he has worked with and chaired over the years, this charity. Here I'm going to share some comments and wrap up.
Hi, my name is Melissa, and I am the Executive Director of the nonprofit Pearl. Thank you so much for allowing me to share a little bit about Pearl with you all this morning. Pearl is a Christ-centered organization providing single-parent families the hope and skills necessary to build an economically and emotionally stable home environment. Pearl was founded in 2008. It was established to help single parents and their dependent children move towards self-sufficiency by providing a variety of programs. Our first program is called the Focus Pearl program. Pearl offers financial assistance and case management to single moms that are currently enrolled in higher education. This can be either college or a trade school. We are currently supporting 12 families on a monthly basis. This financial assistance monthly allows them to spend more hours on their schoolwork and still be able to provide for their children. We also offer a transportation program. Pearl offers monthly scheduled car care clinics for the single moms to come in for safety checks and oil changes. We also accept donated vehicles. We get them in safe running condition and match them to single parent families. We work with a lot of local dealerships, and they offer us discounted rates so that we can do great work and keep these moms on the road and able to provide for their families. We also offer a kid mentoring program. Pearl matches a mentor with a mentee, so a relationship can be built between a volunteer adult and a single mother's child. They currently meet weekly at a local church. The mentors meet with the children while the moms are gathering together, receiving support of their own. All volunteer mentors are interviewed and background checked. They help the children with their homework, and they also do a lot of fun activities and just help these kids build great moral character. We have the Above All program. Each year, Pearl awards academic and camp scholarships to kids of single moms. We partner with the Education Foundation of St. Green Valley and Young Life. And we have also added a COVID assistance program. We have made adjustments in our budget to help meet the needs of single parent families directly impacted by COVID. In 2020, we've done a lot of amazing things with our donations. We've done over $41,000 in assistance to those Focus Pearl families. We've assisted them with rent, utilities, and grocery bills. We've done $5,000 in assistance for vehicle repairs. We've also been able to donate 5 vehicles. We've done $45,000 in COVID assistance, which could be supporting in utilities, rent deposits, and also hotel stays for those that have lost their jobs and been displaced from their homes. We've also paid for hotel rooms for those women that are fleeing domestic violence situations. We've donated laptops to assist in the completion of GED programs and also to assist the children that are currently doing hybrid learning due to COVID. We've done $1,500 in college scholarships to graduating seniors of single parent homes. And here's just a few pictures of some of the families that we've supported this year. If you feel like Pearl is an organization that you would like to support, if you have a passion for helping the children of single parent homes, you can visit our website, www.pearlpromise.org, to learn more. There are videos on there and lots of information about our individual programs. And you can also make a direct donation via our website. Or if you prefer, you can mail a check to Pearl at P.O. Box 1825 in Longmont, Colorado. If you are a Colorado resident, we are a part of the Enterprise Zone, which offers a 25% income tax credit. Thank you so much for allowing me to share with you a little bit about Pearl today. I'm very grateful. It's a mission that I am passionate about, and we've been very blessed to have Jonathan Lacrosse partner with us for many years now. And we would love to share more information with you. So feel free to reach out to me at Melissa, MELISSA, at pearlpromise.org, and I would love to answer any questions that you may have or just share some more information with you. Thank you so much. I hope you all have a wonderful Christmas and a bright new year.
And I'd like to thank all of you for joining us here today. Our next webinar will be February 3rd, which is the day after Groundhog Day, always a crowd favorite, since investors just love using sophisticated technical tools like crystal balls and sleep-drunk angry rodents for telling the future about our markets. So we'll be sending out some links. You can sign up there, and you can go to the website now and sign up if you'd like to join us. And we'll be announcing more details. We're also still open to additional speakers and ideas for topics in February and throughout the year. So as a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content like this and our community. That includes you. So keep an eye out as we begin to feature more deals and funds on the private marketplace coming soon on the website. But for now, we're just doing that with good old one-on-one conversation and facilitating diligence materials and conversations. That entire process will be more useful to you if you help us understand your goals and your preferences. So I'll follow up to chat soon. Meanwhile, hope you have a happy holiday season, and I hope to catch up before the new year. Stay safe and sane.